Welcome all to FSA Learning Module 9, EOC Cues on the World of Taxation. Let us begin. In the current year, Michael's company has a carrying amount of 3.5 million USD and tax base of 5 million USD for accounts receivable. Michael's will most likely recognize difference between carrying amount and a tax base, that is a timing difference. If we have a timing difference, we will indeed have a deferred tax asset or liability. So C is out. In this case, the carrying amount, what's on the balance sheet for the asset, this is an asset because it's accounts receivable, is less than the tax base. In that situation, we will have a deferred tax asset. Carrying amount less than the tax base, we have a deferred tax asset. Why? Because the tax base being at 5 million, higher than the 3.5, means in the future, we'll be able to reduce taxable income by 5 million, more than the carrying amount. We've got the right to pay less tax in the future. Therefore, it's a DTA. Answer is A. James' company has received 500,000 USD of tax credits. Result, free money from the recent installation of solar panels that will directly reduce their taxes. Which of the following best describes these tax credits? Permanent difference? Yes. Taxable temporary difference? No, it's just free tax money. You're just reducing your tax. It's not a timing difference. It's not a temporary difference. It is permanent. You are never going to have to give it back. No deferred tax. Little exhibit here and then a question down here. Assuming a 35% tax rate and the selected data below, the data is above. For the Samuels company, the company's deferred tax liability in year 3 is closest to, what do we have? Equipment value for accounting purposes, carrying amount. In year 3, our carrying amount is 7,000. Equipment value for tax purposes, tax base, depreciation 1,429 a year is 5,714. Difference between those two, 1,286. That is our temporary difference. To work out our deferred tax liability, and it is a liability because the tax base is less than the carrying value, so confirmed liability. To get the liability multiplied by the tax rate, it's 35%. And that will give us 450. Answer is A. Which of the following is added to income tax payable to determine the company's income tax expense as reported in the income statement? Deferred tax assets, deferred tax liabilities. That's what sits on your balance sheet. What goes to the income statement are the movements in such things, the changes in deferred tax assets and liabilities. The answer is C. That's easy if you just know the basics of accounting. A position at a point in time sits on the balance sheet as an asset or a liability. All of those movements flow through the income statement. Jameson Corporation is domiciled in the United States and has significant operations in the UK and Australia. Statutory tax rates are 21% in the US, 19% in the UK and 30% in Australia. This just looks like a long calculation. The company generates profit before... Oh, here we go. Might as well start writing this down. So 2 million in the US. And the tax rate in the US is 21%. 500,000 in the UK. Note these are all stated as USD. In the UK, 19% in the UK. And 750,000, again, US in Australia. And that is in Australia, 30%. There are no other differences between Jameson's effective and statutory tax rates. Jameson's combined effective tax rate is closest to... Well, we're not asked about the difference here, but just for fun, its statutory rate would be where it's based, where it's domiciled. So statutory would be 21. Obviously, that's not what its effective rate is going to be. Its effective rate will be based on this blend. 420,000 paid in the US, or charged at least. 95,000 in the UK. 225 in Australia. 740,000 in total. On total profit before tax of 3,250, our effective rate, what we were charged there based on our profit before tax, 740 on 3,250, 22.769, closest to 22.8, it is B. Which of the following statements about tax rates is correct? The effective tax rate, so our effective tax rate, the tax expense in the income statement, divided by your profit before tax, is typically used for forecasting cash flows. No, not really, because this is the income statement. This would be good for forecasting tax expense, so no, I wouldn't do that. Cash tax rate, kind of self-explanatory. That's the cash you paid. Is relevant for projecting earnings. No, they've got these the wrong way around. C, a company's income tax expense equals the sum of current taxes plus the change in DTA and DTL. Yep. C is correct because they mixed up A and B. Couple of exhibits here. Marcy's effective tax rate was lowest in year 1, year 2, or year 3. So a whole world of calculations to do. Key is knowing what the effective tax rate is. We would need profit before tax and tax expense to calculate that. Do we have it? Well, Exhibit 1 is our earnings before income taxes, our profit before tax. So yes, we do. And Exhibit 2 shows us our taxes. To get the effective tax rate, we are just going to divide our tax expense by our profit before tax. And we need to do it for each year. Let's pick out the relevant figures. Where is our tax expense? Effective tax rate, so it's just in total for each year. So here's the total. So there's our numerators for each year. 42,986, 41,634, and 43,671. We'll divide that by our profit before tax. Do we have it? Again, yep, we have the total up here. So 175,284, 159,349, and 144,863. Just turn those into percentages. 24.5%, 26.1%, 30.1%. We were asked for the lowest. The lowest is here. Which way around is it going? Year 3. Year 3, it is C. Relative to Marcy's effective tax rate on foreign income, so we need to do the effective tax rate on foreign, the company's effective tax rate on US income was lower in each year, higher in each year, or higher in some and lower in others. So that's a world of calculations. Well, let's just make sure we're getting the right figures. Let's just see year 1 to begin with. For the US, we'd have to pick out for the numerator the US tax, the federal, as it's labeled here. Well, for year 1, that would be 31,143 less deferred of 5,325. It's in parentheses, it reduces it. Divided by US earnings. US earnings, 97,321. That would be 26.5. That's for year 1. Foreign, same process. Foreign is 17,591. Plus this time, our deferred of 262. Divide that by the foreign earnings, 47,542. That would give you 37.6%. And you would repeat that for year 2 and year 3. If you were to do that, don't think there's any sense in watching me do it, you would get 26.4, 25.6, 24, and 25.7. So what can we say? Let's just pick out which is higher. In year 1, it's foreign. In year 2, it's US. In year 3, it's foreign. So the answer is C.